Ever pondered over what bonds are and how they work? Well, today's your lucky day because we're about to dive into the fascinating world of bonds. Imagine this. You have some spare cash and you're looking for a way to make it grow. You could store it under your mattress, but that's not going to do much good, so you consider investing. And one of the options you come across is bonds. In the simplest terms, a bond is a type of investment where you lend your money to an entity. This could be a government or a corporation. In return, they promise to pay you interest at regular intervals and return the initial sum you invested at a specified future date. It's like lending a friend some money and they promise to pay you back with a little extra for your troubles. In essence, when you purchase a bond, you're essentially becoming a lender. So, why would anyone want to invest in bonds? The answer is rooted in three key motives: the lure of steady income, the preservation of capital, and the mitigation of risk. Let's take a closer look at each of these reasons. Firstly, bonds can provide a consistent stream of income. When you buy a bond, you're essentially lending money to the issuer, whether that's a government or corporation. In return, they promise to pay you a fixed rate of interest over a specified period. This interest, known as a coupon, is usually paid semi-annually and can be an attractive source of regular income, especially for retirees or those seeking to supplement their income. Secondly, bonds are often seen as safe havens for capital preservation. While they may not offer the potential for explosive growth like stocks, they are typically more stable and less likely to lose value. When a bond's term ends or reaches its maturity date, the issuer is obligated to return the amount you initially lent them, known as the principal. This assurance of getting your initial investment back provides a level of security not found in more volatile markets. Lastly, bonds help mitigate risk through diversification. In the world of investment, not putting all your eggs in one basket is a fundamental rule. Spreading investments across different asset classes reduces the risk that a poor performance in one area will significantly impact your entire portfolio. Incorporating bonds into a portfolio can balance out the potential highs and lows of the stock market. When stocks are down, bonds can act as a buffer, reducing the overall impact on your investments. But remember, just like any investment, bonds are not without risks, which we will delve into later. Nevertheless, their potential for steady income, preservation of capital, and risk mitigation make them an attractive option for many investors. Bonds offer a measure of security, and that's what attracts many investors. Did you know bonds come in different flavors? Yes, you heard it right. Just like ice cream, bonds come in a variety of types, each with its own unique characteristics. First off, let's talk about government bonds. These are issued by national governments and are considered the safest form of bonds. Why? Because they're backed by the full faith and credit of the government that issues them. The risk of default is virtually non-existent, but as you might expect, with lower risk comes lower returns. Next up, we have corporate bonds. These are issued by companies. They're a bit riskier than government bonds because there's a higher chance the company could go bust and default on its payments. But of course, with higher risk comes the potential for higher returns. So, if you're a bit of a risk taker and you're looking for a bond that can give you a nice chunk of change, corporate bonds might be your cup of tea. Lastly, let's talk about municipal bonds. These are issued by local governments, cities, towns, counties, and so forth. They're generally safer than corporate bonds, but riskier than government bonds. The interesting thing about municipal bonds is that the interest you earn is usually tax-free. So, if you're looking for a way to reduce your taxable income, municipal bonds could be a good option. It's important to note that these are just the three main types of bonds. There are many other types out there, each with its own unique set of risks and rewards. For instance, there are junk bonds, which are high risk but offer high returns. There are convertible bonds, which can be converted into stock. And there are zero coupon bonds, which don't pay interest but are sold at a deep discount to their face value. So, as you can see, there's a bond out there to suit just about any investor's taste. Whether you're a conservative investor who prefers the safety of government bonds, or a risk-taking investor who's drawn to the high returns of corporate bonds, there's a bond out there for you. Different bonds suit different investors, depending on their risk tolerance and investment goals. Now that you know what bonds are, you might be wondering, how do I invest in them? Well, let's dive right in. Investing in bonds can be direct or indirect. Direct investment involves buying bonds from the issuer and holding them until maturity. This approach requires a bit of research and understanding of the bond market, but it's not rocket science. You can buy government bonds directly from the government or corporate bonds from companies. However, if you don't fancy doing all the legwork, you can invest indirectly through bond funds. Bond funds are mutual funds that invest in a diversified portfolio of bonds. They're managed by professional fund managers who know the ins and outs of the bond market. You can buy units of these funds, and voila, you're invested in bonds. Now you might be thinking, that sounds easy enough, but how do I actually buy bonds or bond funds? That's where brokers and financial advisors come in. You can buy bonds and bond funds through a broker. A broker is a middleman who buys and sells securities on your behalf. You can also use online brokerage platforms which offer a wide range of bonds and bond funds to choose from. Financial advisors, on the other hand, can provide personalized advice based on your financial goals and risk tolerance. They can help you choose the right bonds or bond funds to invest in. Remember, it's always a good idea to seek professional advice before making investment decisions. So, to sum up, you can invest in bonds directly by buying them from the issuer, or indirectly through bond funds. You can use a broker or a financial advisor to help you with the process. Just like any investment, it's important to do your research and understand what you're investing in. Investing in bonds can be as simple or as complex as you make it. Whether you want to dive deep into the bond market or just want a piece of the action through a bond fund, the choice is yours. Like any investment, bonds come with their own set of risks and rewards. Let's delve into the potential rewards of bond investing first. One of the main benefits is the promise of a steady income. When you purchase a bond, you're essentially lending money to an entity, such as a corporation or government. In return, they agree to pay you interest over a specific period. This can provide a predictable income stream, particularly appealing in retirement when a steady paycheck might no longer be coming in. Another significant reward is capital preservation. Compared to stocks, bonds are often seen as a safer investment. The reason being, if a company goes bankrupt, bondholders get paid before stockholders. This makes bonds a strong choice for those looking to protect their initial investment. But, as with all things in life, there's no such thing as a free lunch. Bond investing also has its share of risks. The first one that comes to mind is interest rate risk. If interest rates rise after you've purchased a bond, the value of your bond might decrease. This could be problematic if you need to sell your bond before it matures. Another risk is credit risk. This is the risk that the entity you've lent money to can't pay you back. If a company or government defaults on their bond payments, you could lose your investment. Credit ratings provided by agencies like Moody's or Standard & Poor's can give you an idea of the credit risk associated with a particular bond. But remember, these ratings are not foolproof. Inflation risk is another factor to consider. If the rate of inflation exceeds the interest rate you're receiving from your bond, your purchasing power could diminish over time. Lastly, there's liquidity risk. Some bonds may not be easy to sell, especially if they're not widely traded. This could leave you stuck holding a bond until it matures. Understanding these risks and rewards is key to making informed investment decisions. You see, bond investing is not just about buying and hoping for the best. It's about weighing the potential gains against the possible pitfalls and making a choice that aligns with your financial goals and risk tolerance. Investing in bonds isn't rocket science, but it does require some knowledge. With that in mind, let's take a moment to recap the key points we've covered about bonds and investing in them. Bonds are essentially loans you give to the government or a corporation, and in return, they promise to pay you back with interest. They're a stable and relatively safe way to grow your wealth, especially if you're a conservative investor. We've explored the different types of bonds, from government to corporate, each with their unique characteristics and risk profiles. We've also delved into how to invest in bonds, breaking down the process into manageable steps. From understanding your investment goals and risk tolerance to selecting the right bonds and purchasing them. Lastly, we've examined the risks and rewards of bond investing, underscoring the importance of diversification and risk management. Armed with this information, you're now better equipped to navigate the world of bond investing. Remember, every investment journey begins with a single step.